So, what if I told you the US economy might be on the verge of a monstrous boom? One that's fueled by a really unique mix of government spending, super cheap oil, and, believe it or not, a surprising connection to Bitcoin. In this explainer, we are breaking down a seriously bold forecast that could completely reshape the economic landscape. Okay, let's dive in. All right, let's get right to the heart of it. The big question from our source material is this: is the United States about to experience monstrous economic growth, kicking into high gear specifically in 2026? Now, that is a huge claim, so let's really unpack the logic behind it. And there it is, the direct quote that sets the stage for everything we're about to talk about. So, for the rest of this breakdown, we're going to follow the chain of events that, according to this theory, could actually make this happen. And it all kicks off with a very, very different kind of stimulus. So, what's the engine behind this, well, monstrous prediction? The whole theory really hinges on a massive injection of cash into the economy. But, and this is the key, in a way that's completely different from what we've seen before. You see, this whole forecast is built on a new stimulus model. This one is driven by the US Treasury, and it works in a totally different way than the quantitative easing programs we've gotten so used to from the Federal Reserve over the past decade or so. Okay, this slide right here gets to the absolute core of the argument. Just look at the contrast. When the Fed injects money, right, it usually goes to the big financial institutions first. It benefits Wall Street, and that leads to inflation in things like stocks and bonds, what we call financial assets. But with this Treasury model, the money gets spent directly into the real economy. We're talking about the world of actual jobs, manufacturing, everyday goods and services. And we are not talking about a small amount here. The source points to a jaw-dropping $900 billion just sitting in the Treasury's account, ready to be deployed. I mean, to put that into perspective, that's bigger than the entire economy of a lot of countries. But the key thing isn't just the huge number, it's where that money is headed. So, if all of this cash is going straight into the real economy, who actually benefits first? Well, according to this model, the flow of money is basically flipped completely upside down from what we've seen in the past. And this slide lays it out perfectly. First, the Treasury spends money on stuff like infrastructure. That means government contractors get paid first. Then they have to hire workers to do the jobs, which means regular people, Main Street, they benefit much, much earlier in the cycle. Wall Street, in this model, they're the last ones to feel the effects. But you knew there was a catch, right? Here it is. Pumping almost $1 trillion into the economy sounds like a surefire recipe for crazy inflation. The analysis argues that for this whole thing to work without prices just spiraling out of control, you need one absolutely crucial ingredient: cheap oil. So here's why that's so important. Cheap oil acts like this giant deflationary pressure on the economy. Think of it like a safety valve. It keeps the cost of transportation and manufacturing way down, which creates the room for the government to spend all that money without causing runaway inflation for you and me. And the analysis points to crude oil continuing its downward trend. The first major target they're looking at is the $50 per barrel mark. That's a huge psychological and technical level for the oil market, but the forecast suggests it might not even stop there. Yeah, if that $50 level breaks, the forecast sees a potential drop all the way to $40 a barrel. A price so low, the source actually calls it insane, an outrage. I mean, at that price, a lot of oil-producing countries would be in serious, serious trouble. So what on earth could drive prices that low? Well, it really just boils down to classic supply and demand. On the supply side, you've got Russia selling oil at a discount. And you have non-OPEC countries like Brazil and Argentina just pumping out more and more. Then on the demand side, China's economy is struggling, which means it just doesn't need as much oil. So more supply plus less demand, you get lower prices. Okay, so that's the theory. But is there any proof this is actually happening? The source argues that we don't even have to guess. The market itself is already dropping hints that the big players are getting ready for this exact scenario. The first huge clue comes from the bond market. Now, this gets a little technical, but basically, the interest rate on the 10-year Treasury note, which is a key indicator of what the market thinks is going to happen, has started to rise. And the interpretation here is that bond traders are starting to bet that all this Treasury spending is going to create real inflation, not in stocks, but in the actual economy. Meanwhile, if you're looking at the stock market and wondering why it just seems stuck, kind of moving sideways, the source points to the state called positive gamma. Now, that's a really complex term,
but in simple English, it just means that big market dealers are basically forced to sell when the market goes up and buy when it goes down. And that pins the whole market in this tight range, just burning time without a big move either way.
And finally, we get to the last piece of the puzzle. This entire macroeconomic theory has this really fascinating connection to the price of Bitcoin, and it all comes down to one specific company that Wall Street is using as a proxy for the asset. Okay, so the analysis suggests that some big Wall Street traders have found a really clever way to control Bitcoin's price without ever touching Bitcoin itself. What they are reportedly doing is buying actual Bitcoin on the spot market, while at the same time they're selling futures contracts on MicroStrategy, the public company with a massive pile of Bitcoin. This creates a kind of arbitrage play for them. Now, this strategy creates what the source calls a wall of selling for MicroStrategy's stock, especially around that $190 per share level. As you can see on this chart, that massive resistance acts like an anchor, not just on the stock, but on Bitcoin itself. And here it is, the bottom line. This quote makes that connection crystal clear. For Bitcoin to really break out and make a significant move higher, it first has to overcome this indirect pressure being put on it through MicroStrategy's stock. That 190 level is the number to watch. Which brings us to one final, really thought-provoking question. If this whole forecast plays out, this government-fueled boom that depends on cheap oil, does it mean the biggest opportunities and maybe the biggest risks are no longer in financial markets? Is the real action shifting back to the real world of jobs, construction, and wages? It's a huge potential shift,